All right, so we've got another healthcare company hitting the market, and you know the story. They're promising explosive growth. But here's the thing, and you know this if you're a serious investor, the marketing hype is one thing, but the prospectus, that's where the real story is. Today we're going to tear apart the Modern Diagnostic and Research Center IPO. We'll find the facts, the risks, and the red flags to figure out if this is a healthy investment or just a recipe for financial pain. So, first up, let's get to know the company at the center of all this, Modern Diagnostic and Research Center. They've actually been around for a while, since 1985, and they've carved out a space for themselves in their local market. But, and this is a big but, a long history doesn't automatically mean it's a great investment for the future, right?
And really, that's what this all boils down to, isn't it? With any company asking for your money, especially in a sector as important as healthcare, you have to wonder, is this a genuinely healthy investment? Or are we about to find some, let's say, pre-existing conditions buried in the fine print? That's exactly what we're here to do.
Okay, here's how we're going to break this down. First, we'll look at what this company actually does. Then, we'll ask the big question, why do they need the money now? After that, we'll put their finances under a microscope. We're going to hunt for red flags, and then, at the end of it all, we'll give you our final verdict.
First things first, Section 1. Let's get right into it. What is Modern Diagnostics all about?
So these guys are not new to the game. They've been in diagnostics since way back in '85. They do the whole shebang, pathology, imaging, the works, for pretty much everyone, from individual patients to big hospitals. And their business model is pretty standard for this industry. It's called hub and spoke. Just picture a bicycle wheel, right? They collect all the samples from the spokes, the smaller collection centers, and send them to the hub, their main lab, for all the heavy-duty testing. It's efficient for sure, but as we're about to see, it has its own weak spot.
All right, on to the big question. Maybe the most important one for any IPO. Why now? Why are they asking for our money? Is this really about growth, or are the founders just looking for a payday? Let's dig in.
Okay, so according to the official documents, the money's going to a few main places. They want to build new centers and labs, buy some new equipment, and they're going to pay off a chunk of their debt, about 4.5 crores. The rest is just for general business stuff. On the surface, this all looks like a classic growth story.
And this is absolutely key, so listen up. This is a fresh issue of shares. What that means is that every single rupee invest goes straight into the company to grow the business. This isn't what's called an offer for sale, where the original owners are just selling their own shares and walking away with the cash. So that's a big checkmark in the plus column for investors. It shows their interests are aligned with yours.
Okay, so the story sounds good, but a story is just a story until the numbers back it up. So let's do a proper financial health check and see what's really going on under the hood.
All right, take a look at their revenue. At first glance, you see growth. But wait a second. Look right there in fiscal year 23. There's a dip. It's not a straight line up. And that immediately makes me ask, what happened? Was this just a blip on the radar, a tough year for the whole industry, or is it a symptom of a bigger problem? And if you thought that was weird, check out the net asset value per share. This is basically the company's book value. It's a total roller coaster. Look at this. In March 2023, it gets chopped almost in half. And then poof, a year later, it's right back up. I mean, that kind of wild swing is a huge red flag. It makes you seriously question how stable this company really is and what its shares are actually worth.
Okay, revenue and book value are important. But let's be real, we're here for the profits. And when we get to profitability, well, this is where things get really interesting.
And this right here is the slide that should make every investor pause. They are claiming a return on net worth of nearly 50%. To give you some context, a major listed competitor, Vijaya Diagnostic, is at about 17.5%. We're talking almost 3 times higher. A number like that isn't just great, it's almost unbelievable. You have to ask, is this company a secret genius, or are the numbers too good to be true?
So, too good to be true is a pretty serious claim. Let's see if we can back it up. It's time to put on our detective hats and dig into the fine print. This is where we find the red flags and the reality checks.
Red flag number 1. They've put all their eggs in one basket. The prospectus is very clear about this. The vast majority of their business is concentrated in just one state, Haryana. Think about that. Any local problem, a new competitor, a change in state laws, anything could hammer their entire business. It's a huge, unforced risk. And that all eggs in one basket problem doesn't just apply to where they operate. It's also who they buy from. Almost 70% of everything they buy comes from just 10 suppliers. This gives those suppliers all the power. If one of them jacks up prices or cuts them off, boom, their business could be in serious trouble overnight.
Okay, get ready for this one. This is something I have almost never seen in an IPO prospectus. Remember they said they're raising money to buy medical equipment? Well, you'd assume that means new equipment, right? Wrong. The prospectus literally says, and I'm reading this word for word, these equipments are not brand new. They are pre-owned, having been previously used. They're asking the public for fresh capital to go buy secondhand gear. That is a massive red flag about their strategy and how they think about quality.
And believe it or not, there's more. The prospectus also talks about a pile of existing debt. The founders have put up their own personal assets as guarantees for company loans, which means if the company goes down, they could lose everything. There are also outstanding lawsuits. And, of course, there's the big question of whether they can even pull off this big expansion they're planning.
All right, let's take a breath and put all the pieces together. We've seen the business model, the shaky numbers, and a whole bunch of red flags. So what does this all mean for the valuation? Let's get to the final verdict.
So we don't know the final IPO price just yet, which means we don't have the final PE ratio. The PE ratio just tells you how expensive a stock is compared to its profits. But we can look at their competitor, Diagnostics, which trades at a pretty hefty PE of around 57. Now, given that modern super high profit numbers look, frankly, a bit questionable, if they try to price this IPO anywhere near that kind of valuation, investors should be very, very careful.
Okay, so after all that, the only question that really matters for you is this. Should you even consider putting your money into this IPO?
Let me be crystal clear here. This is not an IPO for your average everyday investor. This is firmly in the high-risk bucket. The only people who should even look at this are aggressive investors who really know the diagnostics industry inside and out and who are totally comfortable with all the red flags we just talked about. If you're a conservative or even a moderate investor, I'd say you should probably steer clear of this one. There are just too many question marks. So, after all the digging, after looking past the hype and straight at the facts, here is our final call.
Our final verdict is neutral, but only for high-risk takers. Look, the growth story they're selling sounds good on the surface, but the prospectus itself, it just reveals too many operational risks and financial numbers that just don't feel right. For the average investor, the risk here just seems way too high for the potential reward. The question you have to ask yourself isn't, can this company grow? It's, can I trust the numbers that growth is supposedly built on? And for this IPO, that's a very, very tough question to answer with confidence.